Today is Monday, October 9th, and this is the ADM Investor Services Weekly Market Kickoff. Today's guests are Alan Bush, Senior Financial Economist here at ADMIS, and Steve Freed, Vice President of Grain Research. Alan, copper futures advanced from a 2.08 level late last year to 3.16 area in September of this year. Now that copper is trading at the 3.03 level, what is the outlook for copper?
Well, the copper outlook still appears to be bullish. Now, some of the strength was linked to supply disruptions, but we are seeing the global economy improving. So there is good support for not just copper, but I think all of the industrial commodities. So any breaks from here I think should be used as buying opportunities. And that 316 high that we saw, I think that will be surpassed within the next quarter, maybe within the next half.
And why did the probability of a Fed's hike in December increased late last week when non-farm payrolls for September were disappointing and down 33,000 when the increase of 80,000 was expected?
Traders used to place more emphasis on the non-farm payrolls report, but I would say within the last year, maybe a year and a half, it's the wage numbers that are more important. And in fact, while the non-farm was very weak, the wage number was very strong, at least compared to previous reports. So wages were up 0.45%. The guess was for up 0.3%. So that was a big increase. So that means that there is wage inflation coming. And of course, that would imply the need for tighter credit from the Fed, which now it appears that the Fed is likely to raise rates in December. And there is, at this point, a 93% chance that the Fed will hike rates according to financial futures markets.
So if the Federal Reserve is on track to increase interest rates again in December, how can stock index futures continue to advance with the Fed tightening credit?
Well, it's the same as before. When the Fed raises rates, normally that would be bearish, but rates are still low enough to sustain a bull market. So I think even with another rate increase in December, or even another one or two more next year, rates are still low enough that we will continue to see higher prices for stock index futures. So the rule of don't fade the Fed will, I think, not apply here since rates are historically low or still historically low. So continue to expect higher prices for all of the indices, even with a rate increase in December and a few more possibly next year.
Steve, what is the latest concerning South American weather?
Right now the weather pattern is stuck, and it's dry in northern Brazil, it's wet in southern Brazil, and wet in northern Argentina. And that's delaying some of the soybean plantings and also the corn plantings in Argentina. So it has to be watched pretty close over the next couple of weeks to see if this pattern breaks to something more normal or keeps especially dry in the northern part of Brazil.
And what are the fund positions and the technical signals?
Funds right now are long soybeans. They added to that position last week. They're short corn, and they added to that position last week. They reduced some of their soybean oil long, and they reduced some of their wheat short. When we look at the technical picture, soybeans are right back at 50% retracement of the entire move that we had last year from highs to lows. And so we have to kind of decide, is the South American weather and Chinese demand going to push us above this level? Or is the U.S. crop, U.S. harvest going to push us below the level? I think we're still in kind of a trading range. As far as the meal market is, surprisingly, we've rallied a little bit over the last month. And I think a lot of that has to do with the growing Chinese demand and the concerns about South American weather. We also saw some liquidation of the long oil short meal spreads because the oil market took it pretty hard when the EPA came out and said they were going to lower mandates to biodiesel fuel and challenge some of the rulings that have been made recently to help biofuel demand. So far, the courts have found in favor of the mandates. We're not expecting big changes, but the market did take some profits on that. Corn market is near support, and again, the funds are short. It's mostly because of the export demand is slow, and it looks like the crop is okay. Above the market is farmer selling. We'll just hope that we find a price that encourages demand on the downside. Wheat tried to rally, partly because it's that time of year for a seasonal bounce in prices. We were near contract lows, but now it's struggling at prices because, number one, weather's improved here in the United States for our winter wheat planting, and number two, we just don't have the export demand to push us through some key resistance levels.
And is this kind of what the market's expecting with the USDA report?
Yeah, the USDA report comes out, and it's interesting in that it was a dry August and September, but everyone thinks that the lofty corn and soybean yield the USDA said in September will continue to be unchanged and not decline. We also look for maybe the soybean carryout to go up, maybe because of more acres and a little bit less demand, and the carryout for corn to maybe go down a little bit because of a little bit higher demand and a little bit fewer acres. So not a lot of surprises expected, but with USDA reports we always have a volatile reaction by the trading machines.
Great. Please remember that the opinions expressed here today are solely the opinions of our guests and are not necessarily the opinions of ADM Investor Services or Archer Daniels Midland Company. If you have any questions or comments or would like to know more about our services, please contact us at www.admis.com.
Go Cubs,
Go Cubs!
go Bears,
And go Hawks!
and go Hawks.